It's Victor Landor here, known as the Family Guy on my social media platforms, Instagram, Facebook. I'm an executive vice president of the financial services agency known as the Family Organization, helping understand and bridging the gap, teaching people about how life insurance and money works. And I'm super excited to be here on this nice, comfortable chair, spending time with the L Podcast. Hop on, pay your fare, and enjoy the ride.
Hi, and welcome to the L Podcast. Thank you for tuning in to another episode. Y'all already know how we do it each week. Make sure you subscribe to the channel. Make sure you like, comment, and share. So today we have another special guest on the show. Can you please introduce yourself?
First off, Nico, thank you for having me and the whole L
No
Podcast.
problem.
Appreciate being here. My name is Victor Landor, coming from the Humboldt Park area, Wicker Park area, and got invited out by none other than Mr. Nico, so I had to pull up because I love their content.
Thank you so much. So you a city boy. City boy. What's your nationality?
So I get to spread the culture around, right? I'm the CEO of the Mud Life, Black, Puerto Rican, and Mexican. All right, my mom is Black and Mexican. My dad is full-blown pork chop. So
Okay.
I know y'all can just imagine my Thanksgiving.
Yes, that's lit. You got all types of food. Yes, lit.
Yeah.
Okay, so that's good because I want to touch on some points about, because I know that you're familiar with life insurance.
Yes.
And other different stuff, but we're going to start with life insurance. I think it's good for the city because majority of my content base is artists, and life insurance is very important, y'all, because
Yes.
a lot of artists, coming from different demographics and backgrounds have been dying. So I brought just another life insurance agent on here because, this is something that we need to learn and know about. So my first question is, how can we create generational wealth through life insurance?
Great question. So you heard of the Rockefellers, right?
Mm-hmm.
So the Rockefellers, that's how they were able to actually keep their name so relevant and keep passing wealth from generation to generation to generation to generation, because they made it a priority. They made it a part of their family tradition for everybody to have life insurance.
Mm-hmm.
So creating generational wealth is basically having insurance on the breadwinner or a family member that's, a key person, or it doesn't have to be just a key person. But everybody in the Rockefellers made sure that everybody had life insurance. So when that beloved passes away, of course they were able to mourn them, celebrate the life, but then they will also acquire a large X amount of lump sum of money, and they not do whatever they want, but they'll be able to add to the family's legacy and, grow the wealth, continue to, invest the wealth in different areas. So therefore it continues to keep growing and growing and growing, and they never outlive the money. The money will always outlive them. So creating generational wealth through life insurance, it puts families it gives them very peace of mind, because they don't have to worry about the family selling the home, worrying about crashing in or moving in with family members and things like that. Continue to make sure that they fund and finance that lifestyle for the kids and the wife or the husband, whoever's left behind. And one of the biggest things when people don't have life insurance, they don't have generational wealth. They're creating generational debt and generational curses.
Yeah.
Right. And, there's some people in our community that, great grandpas and great grandparents, they worked hard to buy a family property, a family business, or a family, a legacy. But then when there's a beloved that's a key person or a breadwinner that's no longer around, the first thing they do to cover those financials is sell the home, sell the mortgage for a small dollar amount. Next thing you know, the legacy is gone. So life insurance could create generational wealth in so many ways. This just depends on how people want to continue their generational wealth after it's created.
Okay, so then, because it's this black and brown stigma in our communities of why, we don't get life insurance, or, so I want to know, how do you convince someone to invest in something that they can't see?
Great question. Non-tangible, right? Mm-hmm. So, Luke, I want to give you my example. When I got involved into the industry, right? 6'4", my meal ticket was supposed to be basketball. Anybody listening to this, pursuing education, don't listen to this part. But I hated school with a passion, right? My grades are only good when the season was in, so I could maintain a GPA to be eligible.
That's real, though. That's real.
And I thought my meal ticket, my way out was ball, but because my grades and my habits and discipline in school.
What school you was hooping for?
I went to Roberto Clemente High School.
Okay.
But I had looks from D1 schools and things like that. But I've learned that in order to be able to obtain that scholarship, they want you to be a book player before the ball player. Mm-hmm. So that actually affected me. Anyway, long story short, Nico, I ended up in early childhood education. I went the whole junior college route. I called those same schools that offered me the scholarship, and they said, man, your habits followed you through college. You're basically not worthy of this scholarship. So thank God, maintaining healthy relationships. Maintain healthy relationships, everybody. I ended up working as an early childhood educator, student aid teacher. Long story short, I got laid off Laniqua because I wasn't. They couldn't afford to keep me on payroll. And you probably remember when teachers were downtown, red shirts on strikes, demanding money.
Chicago stay on strike.
Yeah,
Man.
the corrupted system, lack of funding and grants. Anyway, long story short, Laniqua, I got invited out to have this conversation. And, my taste in my mouth was like, bro, I'm all the way out here in Oak Brook, and you finally tell me this about life insurance? You could have told me that over the phone. And he's like, nah, so, man, look, let's have a common sense moment real quick. So me at that time, Laniqua, my pride and ego was bigger than my bank account, ignorant, thinking I know everything. So when he said common sense moment, I was like, what you trying to say, bro? He's like, calm down, look at you. He said, when you hear the word life insurance, you thinking death. But what's the first word? And I was like, life. He was like, exactly. And I was like, damn, that do make sense. He's like, if the industry wanted to be known as death insurance, they would have called it death insurance. It's life insurance for a reason. And right there and there, it clicked. And with that being said, when you talk about the black and brown community, we're programmed, or our money blueprint was instilled in us that life insurance is a scam. It's not for young people. It's only for older people, right? And just to combat that real quick, I'm pretty sure you heard of, since you always touching on artists, Big Scar with Gucci Mane on them, right? You heard everything that goes on. Everybody, the family, trying to bash Gucci Mane because they only gave $10,000 for the policy and stuff like that, which is a big misconception that young people do need life insurance too as well, because life happens prematurely. So anyway, long story short, when I have that conversation with people, especially that look like me, come where I come from, of my own kind, I have that same question. Hey, the first word is life insurance. It's insured to life, because life happens before death. And, just like the same way that the beeper went to the Brick City, New Jack City phone, right, to the Razor, to the flip phone, to the Motorola, to the Sidekick, fast forward to the iPhone 14, the same evolution of technology, it happens just like life insurance. It was just for when you die. Now you're able to leverage it while you're alive. But the thing is, we don't know that.
Oh, speaking of leverage, ding, ding, ding. So let's break this down. All right. So what are the different types of life insurance you can get? I know we had somebody else on the show that talked about it, but we're going to go through it again, y'all. So just make sure y'all pay attention and listen. So what is the different types of life insurance? Like,
there's many different types of life insurance. You have the first two, original traditional style, which is term and then whole life. That's the first two. A lot of people just think it's just term and whole life. But the evolution went from term to whole life to universal life. Then universal life, then return of premium, which is called ROP, return of premium. For lack, just for better understanding, just think about it as refund on payment.
Okay, let's go from top. We gonna go from future to past, right?
Yeah.
Cause the return of premium. I was doing my research. That's really popular.
Yeah.
I like that. I like the sound of that. So can you break that down?
So on the ROP side, okay. So the ROP means, let's just say, Laniqua, right? It's like a term policy. It's a contracted time frame. So let's say if somebody has a policy for 20 years, they're putting money away to this policy for 20 years. If something happens to the family in the duration of that 20 years, the family gets the death benefit, right? But if that individual outlives the 20 years, everything they put into it, they get it all back. So let's just say, for example, right, somebody's putting away $100 a month. You times that by 12 because there's 12 months in a year, and that represents annual premium, which means, Laniqua, for every month, for 12 months, 100 times 12, that means that person's putting away $1,200 a year. Now, if they had it for, let's just say, 30 years, you take the 1,200 times the 30, that equates to $36,000. So, Laniqua, after that 30-year term, if the person when the person outlives the 30-year term, the contract's over, but the insurance company's gonna say, hey, Laniqua, I don't want to use that example. Hey, client, hey, thanks for doing business. The policy's expired, but here's your $36,000. Here's every penny.
Tax-free, right?
Tax-free.
Tax-free,
legally, ethically, and logically.
Yes, this tax-free, and that's the process of building generational wealth, right?
Facts. Yes.
Okay, so and usually people live past their term life. Okay,
yeah.
okay. So say if you do have the ROP, but then it's an investment, but then someone passes away, does that money that you invested goes towards the funeral instead of going to you?
Great question, Nick. So the contract is if something happens within that time period, the family, let's just say 500,000. If something happens within the 20 years, the 500,000 will go to the beneficiary. But the 36,000, if they outlive it, that's when you get your money back. That's the only time. So the 36,000 that equates to everything you put into the policy that has nothing to do with the death benefit.
Okay.
So if something happens to the client, they will get the 500,000. But if nothing happens to the client and they outlive that term, they will get the 36,000 and the 500,000 contracts over with.
Okay. ROP.
Yeah. And
Okay.
a lot of people, I don't mean to cut you off, Nico. A lot of people use and leverage the ROP term for what we call mortgage protection. In events if something happens to the breadwinner, the landlord, the owner of the property, they're able to, if something happens to them where they're not able to go to work or perform 2 out of the 86 functions, they're able to take anywhere between 70 to 90% to use it as a living benefit.
Okay.
So what they do with that, they pay off the rest of the mortgage. They, put a down payment on some more property, go get another down payment on the car. They use the money towards the funding and finance of the therapy, rehab, or, just recovering from whatever health decline that happened. And that's another way of leverage too.
Okay, cool. So before that is the universal life policy. Now, what's that about?
So universal life is basically where it's very fixed, meaning your money's it's actually growing where you get to take from the cash value, but the fixed rate of the money in the universal life is anywhere between 0 to 4%, right? So the most you're gonna get is 4%, but if the market, let's say the market tanks, you don't lose at all because there's insurance on the principal of the cash value. Okay. Right. So then.
So break that down. That down some more, because I'm getting it a little bit. So you basically, while you're investing in your life insurance policy, is building interest.
Correct.
And you could take the interest, the most 4% out while you're still building your life insurance policy.
Great question. You can actually take more than 4%. Whatever the principal is, you have access to it. But it's only growing at a 0 to 4%. It's a fixed.
Oh, okay.
Yeah, it's
okay.
fixed.
But that's still good. At least you might need that money one day, and you've been investing. You could take that money out, and then right now we're in a recession, but you still got value of your money when you get that policy. So that's pretty good.
Yep.
Okay, so before that is.
And then the next one, or before that, so is whole life, then universal. Then the next one is variable universal.
Okay.
So variable universal is basically where your money's in the stock market, but it's also exposed to risk and losses. So let's say, for example, a good year, the market does a great return, your cash value will grow because it benefits from the gains of the market. Now, it will grow, but now let's say the market tanks. You had a good principal last year where your money grew. Your principal was about, let's just say, 80,000. But the following year, the next year, the market tanks. That 80,000 is gonna ride the wave of that market, so it'll lose.
Okay.
Because it's in the stock market. It's a variable.
Well, I don't think that's a good policy to get right now.
And the crazy thing about that too, Nico, is that not only would the cash value be affected by it, but also the death benefit could be affected by it too as well.
So that's dangerous.
Yeah.
That's dangerous.
That's for those that are down with the risky type of investing. Yeah.
Right. Okay, so then did we do premium?
Yes, ROP, UL, VUL, the index universal life.
Okay.
So the index universal life is where your money's mirroring the S&P 500, the Standard & Poor, top Fortune 500 companies. Nike, Yahoo, Google, Apple, Johnson & Johnson, Procter & Gamble, right? Where your money's is growing anywhere between a 0 to 11%. So you have a basement and you also have a ceiling, right? So let's say, for example, the market does 20%. The client will receive capped at 11%, right? Now next year the market does 8%. You will get all 8%. But let's say the coronavirus was to come around again and wipes out the market negative 38%. You would not lose a penny because your basement is 0%, meaning you have insurance on your money to never lose. So the basement, which is the floor, means, yes, the market crashed, but your money stays right here. You don't make no money. You don't lose no money. Your principal is safe because of its it's insured during those hardships of the market.
Okay, that's really good, y'all. I think
Yeah.
this is nice. This is a good investment of life insurance. Who knew you could do all this with life insurance? And it's tax free.
That's
It's
right.
tax free.
Yeah.
And then you get the opportunity to learn about stocks, invest in things. Like, it's pretty good. So it's almost like a savings account and investing, right?
Yeah, it's like if you think about it, like there's three. I'll just give you the three types of ways that money grow. You have the fixed, the variable, and then the index. Now the fixed are all bank products. The upside and downside. The upside of a bank product is safe. Our money's more safe in the bank because what? Paper could burn and it could get stolen. Shoebox money, something can happen. It's safe up to 250,000 FDIC insured. But the downside is our money's not growing at the rate we need it to grow, which we have to factor in this thing called inflation.
Yeah.
And it's like I tell Anika, all my clients, they be like, what do you mean by inflation? I hear about it. I was like, okay, look, let's rewind.
It's high.
Remember
The
when we used to go to
taxes
the
is high.
corner store? 4 bags of
It's a
chips for
juice
$1, right? Sugar tax, bag tax, all kind of tax. That same bag of chips was for $1. 1 bag of chips $1.29. So that's inflation. You probably seen eggs. Eggs are like $9 a dozen.
Yeah, like eggs is crazy. What's going on?
Yeah.
What happened to the chicken? Dang.
So with that being said, in the bank product, Laniqua, CDs, checks and savings, money market accounts, your money's not growing at the rate you need it to. It's like just say they're giving us 1%. We also have to factor in inflation because if our money's not competing or beating inflation, we're always depreciating. Our money's losing. Now, I'm not saying, everybody take your money out the bank. I'm not saying that because it's very convenient to have money in the bank. You have safety. You could wire money. You have direct deposit. You have auto draft, which is good. But as far as long-term saving or building a muscle of, money for whatever reason, the bank is banking on your bank for them to make bank, but they'll never teach us how to create that bank, right? So that's fixed. The next one is variable, which is the 401ks, the 403bs, the 457s, the IRAs, the TSP accounts. Those accounts are variable because there's a lot of ways. The keyword varies. It varies because there's a variety of ways to make a lot of money, and there's a variety of ways to lose a portion of it or all of it. So the upside is you got unlimited growth to make a lot of money. But the downside is the same way you can win, you could lose.
Okay.
Right? Now, the one in the index is what we're talking about. You have the safety where your money's insured to never lose. You'll never lose a principal. On the other end, you have a very conservative growth of money growing anywhere between 0 to 11%. So that's teaching people how to bank on themselves, create their own pension, their private 401k, do a life insurance vehicle.
Okay, and then let's go to our basic policy, term life.
Term life. It's a basic contract where the client has the option anywhere between 10 to 30 years. They're insured for the duration of that period. Like one thing, too, is that, life insurance, when it comes to term, they only pay out 2% of the time because most of the time people outlive the term. So the term policy is basically saying, hey, client, for $50, and it's very inexpensive. You get a whole lot for very little because it's only insurance. It has nothing to do with the cash value, the money component, right? So a term is a client pays X amount of dollars every month for a certain amount of coverage. If something happens to them, they get that death benefit. For example, $50 a month, let's just say client to get $500,000. The contract's at 20 years. If something happens to the client within those 20 years, the family gets the money. If the client outlives the 20 years, the contract expired and you go your way and the company goes their way and you no longer have insurance because the contract is up.
Okay, so I know when you do contracts, you gotta have a beneficiary.
Correct.
That's when the person dies, they're allowed to either get the money or
Yeah.
So why shouldn't you put your child as a beneficiary?
Great question. The reason why it is because depending on the companies, different on the contracts, the children, they only have access to those funds at 18 years old or sometimes 21 years old. So what happens is if a family or, the parent passed away prematurely and the kid's only 9, that's another 9 years they got to wait to actually receive that income, right? We also say, too, when it comes to if you add a kid as a beneficiary, also add, because you're able to put up to about 8 beneficiaries on there. So you want to put somebody in there that you trust, has your best interest for your family and your kids and whoever you leave behind. So like for grandma, a granddad, a mom, a dad, a brother, a sister, a sibling, an auntie or uncle, it's good to have somebody like that added as a beneficiary because they have instant access because they're of age. But a kid, it's not because, I mean, I'm not saying it's a bad thing, but it's up to how people want to do it. But most of the time, too, a lot of those death benefit claims go unclaimed. So right now, there's over hundreds and hundreds of billions of dollars of unclaimed life insurance because the proper arrangements wasn't put in place, especially when there's a kid. The kid doesn't know, especially if there's no design planned on what to do with this money after that, after that beloved is gone. So that's mainly the reason.
So for the design plan, can't you use a trust?
You use a trust because a trust is basically you giving your money a GPS with legality saying no matter, even though I'm no longer here, this is what I want my money to do, right? So I have like my mentor. He talks about his trust all the time. He says, shout out Master Paul, the money smart guy, follow the 7-figure squad, right? He always says, his trust, it says, for every year, his daughters, no matter where they're at or how old they are, every year, his trust is designed to send his daughter a bouquet of roses, a big box of chocolates, and do so many other different things. So even though you're no longer here, your money still has instructions. Your money still has
Okay, so a trust
direction.
is basically you could give direction on how you want your money to be spent.
Yes.
Basically.
Yep.
To sum it up.
Yep.
Okay.
Yep.
Okay, cool. So I believe we touched everything. Oh, no. We have to talk about this. If you're a felon, how can we get them life insurance?
Great question. So I wish I could get felons, approved. And here's the thing too, sis, when people apply for life insurance, they think that, money buys the life insurance. It doesn't. What buys the life insurance is the age, the health, also if they smoke cigarettes, consume tobacco, nicotine, chew tobacco, things like that, because now you're at a higher risk. So the insurance companies are looking like, basically, Laniqua, everybody's a liability to life insurance. And here's why. Just to answer your question, there's people that buy a policy, they only have it for 2 years. The contract is if something happens to the client, the family gets the $500,000. But the thing is that they're only putting away $100 a month into that policy. So if they had it for 2 years, that means total in those 2 years, they only put away $2,400. But if something happens to them, the company got to cough up $500,000. So who loses in that point?
Yeah, the
insurance company loses, right? So insurance company know they're losing, so they're going to do a very thorough, extensive background check. They want to make sure, like, when it comes to the felons that, you ain't about that life. You ain't got no rap sheet. You ain't got no records. You're in jail. Because what they basically saying is like, man, they're higher risk. They sign up for that life. They're in and out of jail. They got a record. Something could happen to them at any time. So we're going to cough up all this money to this person that's, putting their life in danger and living that risky life. So chances are most of the time they won't get insured. They won't get approved. But under certain conditions or some, depending on what the record is, how long the probation period, the parole period and all that.
So there's some hope.
There's some hope, yeah. They want them to prove themselves after a certain amount of time after they serve the time or the probation period or the parole. And then it gets to the point, too, where sometimes the insurance company will say, hey, I did my due diligence on person A. They got this going on. They got that going on. It look like they're getting their life together. Can we get a couple letters of references? So they have people sign in like, yeah, my cousin, man, that was his life. He deserves a second chance. Since then, he's took custody of his kids. He has a full-time job. He stayed out the way. You just want to know that they're changing their life around so they can actually entertain insuring them.
Okay.
Yeah.
And so this is my last question. People who are special needs or have diseases and stuff like that, how does life insurance go for them?
Great question. So with that, that's like it's like a liability too as well to the insurance company. But there's a way with that. They can either get, they qualify depending on the situation, final expense. Final expense is basically the last expense, the final expense someone will make when it comes to arrangements for the homegoing, the burial, the type of reception they have, the type of service they have. That's the final expense. They could, go that route. But if they don't qualify because of their health condition, they're able to get what we call an annuity. Now, life insurance, an annuity is basically a contract between you and the insurance company saying a large lump sum of money, whether it's a lump sum dumped once or there's a contribution every month, it's just a policy to put in place where if something happens, you have money. And the reason why somebody with prehistoric medical conditions or the diseases that you brought up, they're able to have a better shot with the annuity because the annuity doesn't have anything where there's a qualification in the lines of health. They don't look at the health. It's just the conversation of money, which can you contribute to, whether if it's a lump sum or monthly, and they'll have coverage that way.
Okay.
So, of course, we know that they want the nice design policies with all the benefits, but if they don't qualify for it, we do have a plan B route.
Okay.
Yeah.
So I did say that was my last question, but I lied. This is my last question. So, dedicated to the hip hop community. Say you are an artist, right? And you coming out of the streets of Chicago, and you know your family low income, low poverty, but you end up getting a big record deal.
Yeah.
You end up getting a big record deal. You got a background, but you got the funds to pay to get like life insurance and everything. And we could use King Von, for example, rest in peace. But what would be your advice to a rapper who just came across a wealthy deal, low income family? He got a high risk job, but he's making like a lot of money. So how would you talk
Great
to
question.
that artist?
I would say, number one, get an attorney, right? Because most of the time when artists come up like that, most of the time we come from the trenches, from the slums, from the mud. You know, when we come across a large lump sum of money, lottery, jackpot. We look at 100,000 like it's a million, but in reality, like, you know, every dollar that we touch and that's going to be paid out to them, they got to pay taxes. You know, everybody, we all related because we got the same uncle, right? Uncle Sam, he wants his money. So I would say get an attorney to make sure the money's being watched. And also have somebody that's, because most of the time the downfall with those people that, you know, artists that come up like that, they have the wrong people in their ear giving the wrong financial advice. And because that's their beloved, they friends, this is my clique, this is where I'm from, this is my people I came up with, you know, they feel obligated to do those type of things. And then they lose out because they didn't dish all this money out and they no longer have no money. And another thing is with that too is having an attorney and somebody that's means well by you, have the best interest for you, to actually thoroughly read that contract. Because they sign a contract with their name, their ink is dry, next thing you know, it's a 90-10% type of game where the company benefits 90%, the artist gets 10%, but they're doing all the work, they're getting all the spins on the radio, and you would think, man, they eating the whole time. That's the company eating. They just the flag carrier for the company, right? I will also say too as well, get a trust, right? Because most of the time artists, their fame, it could go long depending on what their game plan is. If they got a smash hit and they dropping albums that's hot, there may be some longevity into it. But then you hear the one-hit wonders. Then the one-hit wonders, that little money that they had at that time, it's already gone and they back to what they know, right? So I would say financial literacy, gain some financial literacy. Learn about life insurance too as well because, you know, life insurance, especially if they're artists and they're still living their life, as much as the people we've seen, like, for example, Quavo, his whole family's arguing. They're going back and forth beefing because of all his money. Take off.
Yeah.
Knock on wood
But
for
Quavo, that's his cousin,
That's
though.
his cousin, yeah. But his family take off. They're going through all these things. It's a lot of beef, unnecessary madness going on because they're fighting over the money. Mm-hmm. Now, Takeoff would have had a trust and a will and some life insurance. Everybody would have been, you know, taken care of. It would have been less, you know, all this commotion that's going on. But the thing is, when they come across this large lump sum of money, they think it's just always going to continue to come in, and it's not. But they could take whatever that X amount is and plant those seeds. Mm-hmm. You know, plant seeds because, you know, this comes to a conversation of multiple streams, right? You got like Dirk. Dirk was talking about how he started to look at different avenues. Now he has contracts with Walmart where he has 18-wheelers, you know, driving across the country where he has rental property. So he's diversifying his money because he knows he's hot right now for the last 10 years, but he also knows that, you know, this could be over any time. Mm-hmm. But he still has his rap money still paying him as if he was still rapping, and that's creating other streams of income, other revenue streams.
Okay, that was a lot, y'all. But this is a very, very good episode. I'm definitely an advocate for artists, so I hope y'all please listen to this. Even if you're not an artist, this still was good information. So thank you for tuning in to the L Podcast. Thank you so much for being on the show. Yes. Anytime. And we will see y'all on the next episode.
I love this show, y'all. Give her a follow, show her some love, and go follow her on all her social media pages.
Thank you.
Love, sis.